Yes. So I welcome you all to the webinar series 27 on regulatory requirements and overview of internal control frameworks. Before we start, I would like to welcome our ICAI President CA Charanjot Singh Nanda, CA Prasanna Kumar D, Vice President ICAI. They cannot join us today because of some pre-commitments. So also, I would like to welcome CA Chandrasekhar Chitare sir, Chairman of Internal Audit Standards Board's ICI and the CCM member. I guess he will also not be joining us today as he has some pre-commitments and meetings. So today with us we have the speaker for day CA Mohit Gupta sir. I would like to introduce CA Mohit Gupta sir. He is an experienced risk professional having more than 20 years of experience to lead large and complex engagements for internal audits, risk management, and developing standard operating procedures. He is a chartered accountant and a qualified IT engineer and a managing partner of Process Sage Business Solutions. He is engaged with SNB as an executive director also. He has previously worked with Mazars, Deloitte, Genpact, and KPMG, where he has supported his clients for delivering various risk consulting engagements covering wide range of sectors across the globe, with primary focus on manufacturing, energy, and automobile sector. He is a member of the National Council of the Institute of Internal Auditors, India, and member of Board of Governance for Delhi branch of the IIA. He is also the co-author of Technical Guide on Risk-Based Internal Audit Planning and Checklists on Internal Audit, both published by the Institute of Chartered Accountants of India. He is also engaged with ICSI, ICAI, and IIA as a faculty and speaker for internal audit, data analytics, internal controls, and new ways of audit leveraging through technology. I welcome you, sir, for this webinar.
Thank you. Thank you so much, ma'am.
Yes, I guess we can start the session, sir. And at the end of the session, we can take the questions of the members, and we can address those questions at the end of the session. So I hand over the platform to you.
Thank you so much. And very good evening, very warm welcome to all the members and the fellow colleagues. Yet again here for the another session. So really excited. Look forward to interact with you all. As I just mentioned, though appreciating the entire agenda schedule, we have kept the questions in the end. But rest assured, being after taking so many sessions, I'm generally aware of the kind of queries that comes in, and I will try to do the justice from my end. But if there is anything, please keep taking notes. We take the questions in the end, and I will address each and every query which you have in the mind. Let me just share the presentation and then we start. I hope my screen is visible.
Yes, it is, sir.
Okay, so today I think it's a very interesting topic. We are going to touch upon the internal controls and the regulatory requirements, because of which I think we enforce this kind of a control framework. But I think for a time being, I'll keep aside the regulatory requirement. We covered that aspect also. But what's more important about, say, internal control is today we talk about the governance, we talk about environmental, we talk about process level, we talk about technology. I think every organization is encompassed and impacted by so many risks around it. What is one thing that helps the organization address all those challenges and the risks is the effective management of the risk, and that will be through strengthening the control environment. So what we are going to start with is understanding the risk landscape, the dynamics around it. What do we understand by the internal control? Various categories, the varieties of it. How do we look at whenever we are going to build any effective internal control framework? First of all, how do we address the completeness of my risk identification exercise? What is it something that the challenges or the uncertainties which the organization is faced with? And then how do we ensure that we develop a robust, comprehensive, and a strong internal control framework to be able to manage those risk environment very effectively. Once we have the broad understanding about it, then we start touching into how the journey has been, why the regulators then step into the shoes of the governance, and there is a need that through certain regulations for certain class of organizations, the internal controls framework have been mandated. And we as a chartered accountant, wherever we issue our reports, as the statutory audit report, while we give our opinion and the views of the financial statements, we are also supposed to issue a report around our comfort on the internal control framework which an organization has developed. So there's a whole lot of story around it, there's a journey, and eventually the goal is that we prevent the stakeholders well. I think with that global motive and the objective in mind, let's go through the today's session. We start with the risk because the underlying objective is some or the other way we are trying to address the risk. How we are going to do it, we look at a structured mechanism, and that structured mechanism we are talking about, or we are giving it a name of the internal control framework. And as we generally understand, I think let's take it in a very pragmatic manner. Risk is nothing but an uncertainty. Today, when we step out of our house and we have to go to the office, there's always a risk that an accident may happen. Whenever we are doing any new task, there's always a risk, 50% probability of having a success, 50% probability of not having a success. We are writing an examination. There is, we always think of, okay, whether we will be passed or not. There are certain factors which are in our control. We can study better. There are certain factors which is not in our control. How difficult the question paper may be, whether it will cover something that we have read or not. So if I have to keep it in a very simple manner, any uncertainty that we have in our mind today, when we look at the future and whatever subject we are talking about, if I'm talking about a corporate, looking at the goal of the company, whatever we want to achieve, whatever uncertainty we can attribute, which can protect us from achieving that objective, in simple terms, we call it a risk. It's as simple as that. For example, in our day-to-day life, we have kept certain examples. We are crossing the road. We may hit by a car. It's a risk. We can think of that we will drive carefully, but you never know whether the other person is driving the carefully or not. And why am I again taking both these aspects together? Because eventually I want to also address that risk is not only something that can happen to us because of our own action. It can also happen to us because of the action taken by the others. Because we work in a dynamic environment. We are interact with the other people. Any process, any activity we do, it's a collective effort. The outcome is the collective effort of how the people work together. If to drive to the work, reach and I have a target, I have a meeting to reach at the 9 a.m., there could be a traffic jam, unprecedented traffic jam, cutting the vegetable, cutting your finger, playing a cricket, you are trying to, play for a six, but you can get caught by a fielder. So anything, whatever scenario, the important line is the objective. When I'm trying to address a risk, we have to keep the objective in mind. Whatever objective I'm addressing, and any scenario, any challenge, any uncertainty, where we could attach any probability, any uncertainty, which could protect us, prevent us from achieving our goals and objectives, we classify them as a risk. Now we look at the broader categorization of the risk. I think these are certain risks, we classify them as an environmental risk. Now, because an organization is working into certain environment, they are exposed to certain risks. You are an NGO. There are certain regulations which are governing the NGO. You take the grants and then you operate and try to meet the objective of the NGO. We are working as a profit organization. There are certain regulations. There is a certain market. There is a certain customer segment. There is a certain product that we are dealing into. There is certain geographical boundaries we are dealing into. There is a certain environment in which we are working. And as an organization, they are exposed to all the risk, all the uncertainties that come to the organization only because of the environment they are working in. So take an example, any organization working in India, the kind of regulatory and the political challenges that organization would face would be very, very different than the organization which is working in US, UK, Russia, or any other country. So the regulations, the impacts for those countries, the requirements for those countries, the challenges would be very different. We are dealing, take an example again in the export, import, the economic and the financial matters. We have a trade with Russia, and suddenly one fine day, Russia, Ukraine gets into the war, something which is not in our control. We are exposed to certain risks which could happen to an organization because of the factors beyond our control. Now, that is something that we categorize as an environmental risk. Then comes the another category of the process risk. Now, process risk is something to achieve the organization goal, we undertake certain business activities, certain step-by-step process we follow. We do the procurement, we do the sales, we do hire the people for the purpose of managing the operations of the organizations. We may manufacture a product, we may collect the money from the customers, we do the accounting, and we do the reporting. To do all this high-level business activities, there are step-by-step so many tasks that an organization does. Now, while we do all those step-by-step tasks, which we call the operations, any risk attached to the process that we follow for the purpose of achieving the larger goal, those risks we classify under the process risk category. Now, how it's very different from the environmental is, I think the larger portion of the process risk, apart from the coordinations or the communication that we establish with third parties, I think the significant portion of the process is in our control. And hence, whenever we talk about risk management, internal control framework, I think we always think of and we try to build a framework that how can we strengthen something which is in our control? What steps as an organization and a management we can take to mitigate the process risk, and eventually my entire risk landscape, the gravity of the risk in which an organization is sitting, how can we bring it down? And then the third most important is the decision making. The kind of decision the organization take, it is again some calculated factor. You may want to launch a product, you may want to enter a new market, you may want to acquire an organization, you may want to take a leverage decision, whether we borrow or we push in our equity, whatever. Any key decisions has some probability of success, some probability of failure, and hence the uncertainty. So we classify all them under the strategic risk, the decision-making risk. Now, what is more important is that why it is important that we are studying this category, why it is, and how do we identify any particular risk, in which category does it fall. And I'm going to take a very classic example today. I think these days we all are witnessing the kind of chaos that is in the news from the Indigo case, wherein a lot of flights have been cancelled and a lot of chaotic situation being created. Now just try to apply them into this framework and see what kind of a risk it may be. Is it an environmental risk? Is it a process risk? Is it a decision-making risk? It would be very difficult. Where do we put in? Somebody will say it's a process risk. You have not taken an action. You have not deployed the pilots. You have not deployed the crew. You are cancelling. It's a process risk. Somebody may say it's a decision-making risk. Why did not we take the decision in time? Why did not we start the activities well in time? And somebody may say it's an environmental risk. Only because we are bound to follow certain guidelines, certain legal requirements, certain regulations are imposed on the organization, and we face challenges in meeting, complying with those regulations, hence this risk. You will see it's not easy deciding, but what's more important is we understand the reason and the root cause. And depending on that, we are able to categorize it. And once we understand the root cause, if the root cause is the incorrect decision making, we address that, then it becomes a decision making risk. If the root cause is attributable to the process that we were supposed to follow, we did not follow, it is a process risk, and we try to build an internal control around it. And if it's a risk which is beyond our control, we take a cognizance of that risk well in time. We understand that, okay, there are certain things we are not control, but we are bound to comply it. Let's start better preparing well in advance, whatever we could do, or have an open communication channel. How do we can, minimize the impact of it? That's the normal philosophy, and that's the high level mechanism through which we address any risk. And hence it's very important that we understand the root cause of the risk very, very detailed, very, very accurately and minutely, because the control framework, the subject which we are going to touch upon, is dependent on the effectiveness of the risk identification exercise and the effectiveness of the root cause that we understand because of which that risk prevails. So let's take a very day-to-day life, a simple procurement example in the organization. This is the high-level purchase process that I have depicted here. You have to do the procurement, and the objective is that you procure high-quality material at the most optimal cost. So if you look at the process, it will look like that you have the RFP process, you invite the tenders into the sealed bid, you evaluate them, you appoint the vendor. Once the order is given, you receive the material. Once you receive the material, you make the payment to the vendor. But if you look at the process, there would be so many risks that will be associated with it at each and every step. At the tender level, that you do not invite the vendors from the qualified people, somebody in the purchase team, you depute them, make them the in charge. They call the bids from their non-parties. The person who can give you a very good quotation and a good quality, probably they are not even invited. Leakage of information of the financial bids, it could impact you, that it will not be an optimal cost. Selection of an incompetent vendor, eventually my operations getting impacted. Inadequately defined contracts, if I do not define the contracts, I'm not able to protect the company's interest. There could be delays in the receipt of the material, there could excess shortage of the material, excess shortage payment of the vendor, and list goes so and so and so and so and so on. Important is that how do we identify the risk? And hence it's very important that the first step is that we make a process map. We look into, okay, step by step, what process activities we have to undertake. And at that level, we try to understand what can go wrong. Right? Somewhere it's a scenario building exercise also. Somewhere we leverage our experience also. And somewhere I think there's a methodological approach that we address what can go wrong into each and every particular step. What's more important is that we identify all the risks that are associated in a particular process and a sub-process. And then what most important is that for each and every risk, we understand the root cause. Now we understand the risk is something, the uncertainty, because of which we may not achieve our objective, uncertainty of something going wrong. Now root cause is basically speaking the reason because of which that risk can occur. So we get into the ground level reason. We may say, okay, we may not be able to achieve our target EBITDA of 10%. Okay, that's a risk. That's a risk an organization may say. But why so? Do we not have the sufficient demand in the market? Do we not have the sufficient production capacity? Do we not enjoy the sufficient margins because the market has become more competitive? There could be the n number of reasons. If we are able to identify and map the reason because of which that risk has the high probability to occur, we will be able to address that reason specifically, and that in technical terms we may say is a root cause. For example, what I have mentioned here on the slide is an operational risk that there could be the accident at a project site. Now, this is a risk, but there could be so many reasons because of which that risk may be there. We do not have the policy on the health and safety, so people do not understand what are the best practices on the health and safety we have to follow. We do not do the upkeep of the maintenance of the equipments on a regular basis. There could be the faulty safety alarm systems, or there could be any inferior quality of the equipments, whatever. It could be training issue, it could be the machine issue. But it's very important that when we are doing a study for an organization, in the plan, in the perspective of that particular organization, what could be the reasons? And all those reasons, we categorize them as the root cause. Then what is important is, for each and every root cause, we will put up a control in place. Now, control, as of now, we just say, okay, any activity, any step that we take to mitigate that risk or to prevent that reason from happening or reduce the likelihood that that event may not happen, we call it as a control. For example, in this case, we say, okay, high safety machinery and equipment being used. We ensure that the regular maintenance is being done through my preventive maintenance activities. We follow the appropriate training mechanism to the people. We have the quick medical response team available if something happens. We go and do the testings of the alarm systems. Regular drills are happening, all those things. Now, all those controls will ensure that the chances, first of all, the chances of that risk, that the accident at the project site may happen, will reduce significantly. Even if it happens, the damage it can cause to the organization, that damage be controlled to a large extent. Now, that's how we define, okay, what is the process? We identify the underlying risk within that, and then we try to identify what can go wrong or the controls that are required to mitigate that what can go wrong. Okay. With that subject, it's very also important that is it like one-to-one mapping? For one risk, could there be one reason or could there be more than one reasons? So we all would agree that for any particular thing can happen, there could be a cluster of the reasons which can collectively attribute to that risk. And as we saw just in the previous example, for that accident, there could be multiple reasons. So it's not one-to-one, it's like many to many, right? Because of one reason, there could be multiple risks. I will say operationally, it will impact the people. There could be the financial there could be regulatory non-compliance. There could be the financial impact to the organization. So because of one reason, the organization may face multiple risks as well. And for one risk, there could be multiple reasons and the root causes as well, right? And why it is important? That to make an effective internal control system or an internal control framework, we are able to make a complete list match that what all reasons can result into a particular risk and what all risks will emerge out of all those reasons, so that we are able to prioritize them and then develop a control framework. And then for each and every root cause, we try identifying the controls as we just saw in the previous example. Now, another important aspect that in the introductory slides I would want to introduce is the challenge which we generally all face is typically how do we ensure the completeness of the control? This being asked to me multiple times, do we leave it to the judgment of the people that whatever they define is enough, is sufficient? And as an statutory auditor, when we have to go and comment on the internal financial controls, somebody can just have a risk and control matrix, and I will introduce you to the risk and control matrix in a while. But just to bring on the concept here, that if there's a risk and we mention all those controls on a piece of a matrix, we call it a risk and control matrix. But for example, in a purchase process, I have a risk and control matrix containing 15 controls, and I may have the another risk and control matrix, it may have 50 controls. How do I ensure? For various organizations, and even for the same organization, for various process, various locations, various places, it would vary. But how do we ensure that it's complete and accurate? Because that is something that as an auditor, I would want to satisfy myself before I give my opinion on that. And as management, it is very important that they understand it. Otherwise, the entire effort which is being put to put up a control framework, that is of no use. because there could be certain aspect scenario that remains unaddressed. Having said that, yes, I understand it's a dynamic process. The process may keep on changing, business may keep on evolving it, and hence the control framework also needs to be revisited and improvised regularly. But at any particular time, how do we ensure that it's a quality framework? There are right set of a risk been identified, right set of a controls have been identified, and those are sufficient enough to manage that risk effectively. So we'll see all that in these slides, but just broadly to answer that is, or for all operational risk, if we do a root causing exercise properly and we have the controls addressing all those root cause, we can say the operational risks are addressed effectively and my control framework is good enough. And for all financial reporting risk, we have something called financial assertions. I'll just give the glimpse of it. I'm going to study it when we introduce the regulatory requirements around it and the framework detailed introduction. But there are certain financial assertions for each and every activity and the control. We try to address that all these assertions are addressed. And how do we do it? For every risk, we map whether this control is in place addressing this assertion. If we have the control for each and every assertions in a particular risk, we can say the complete controls are identified. I'll try to clarify with an example. It may appear to be a little complex. So for example, I'm addressing a payment risk that there is a possibility that while processing the invoice, I do the correct recording of the invoice in my books of account, because that is the liability process. And if I do not record the liability correctly, my payment, and there could be a number of risks. My financial reporting is not correct. I can end up paying incorrect payout to the vendors and all that. To address that, I need to see what is the control in place that will ensure that the accounting that we are doing, that has been done for a transaction that has occurred. So I'll make a control that like a finance team process the invoice once it is received from the operations team after verifying the purchase order and all that aspect. How do we ensure the control in place to ensure the completeness, that all the invoices that is received within a reporting period, all the invoices have been recorded. So what is seen in the organizations, you do the hash totaling and the serial number of the invoices received, you make a bunch, send it to the person, and then they do all the reconciliations of, okay, all the invoices are received that have been recorded. Valuation, the value at which the invoice is recorded, that value is correct. Do we have the control in place for that? Rights and obligation, the person who is authorized to put that transaction is only doing it because somebody else, they may have their vested interest. The segregation of duty concept is an approval concept. We'll touch base on all that. Presentation and disclosure, whether that's been accounted correctly so that eventually in my financial reports, it's presented in the right head. So for every risk, we have to see that we have a control in place to address these assertions. Once we address all these assertions for every risk, we can say my control framework is complete and there is sufficient number of the controls identified to mitigate those risks in place. So that's on how do we move from risk to the root cause to the control. We'll just see from some examples, again going back to the same purchase process. For the simplicity, I take the same process and we saw some risk. Now let's try getting deeper into those risks. How do we implement that what we have learned into the framework? So the first risk is like the no quote received from the qualified vendors. So the root cause can be that we do not even have the list of empaneled vendors. Everybody just invite the quotations from some people they know. So we should, as a control, have a list of the empaneled vendors. Then we know that for every item, who all are the vendors that should be invited for the quotations. Inadequate market information. People don't even know. So take an example, I'm setting up a new industry or a new product. It's an R&D item. We don't even know. It's not that we just suddenly go and try to put up the bid on a portal or send it to our existing vendors. I need to do a thorough market research. Who are the people who supply that, who are good into it? Then we can decide we go for the open tender or a limited tender. And that's how we identify the parties. Leakage of information. Again, the root cause could be we do not have the adequate storage mechanism. We may have the collision between the employees. And then to address that, we have the lock-in keys. We would have seen typically in the old days, now it's all automated and the digital systems are there. But I'm taking a simple example so that we are able to address and understand the control in place. And then it's just the automation of the same control through a technology. So they were like boxes, the sealed boxes. If an organization invites the tender, you go put your tender into that box, and then that key was supposed to be with all the committee members. So when all the committee members come, they jointly open the box, and which we call the tender opening scenario. Now today that happens through the systems. You have the encrypted lock. Once you put in 2-3 people put in the password, then you open it. But those are typically the controls put in place to ensure there's no leakage and the complete transparency in the process. Appointment of the vendor. You have not identified my selection criteria properly. Now I'm taking the root causes which are generally being missed. Now, if you do not evaluate it, that's a very simple root cause. Okay, once we have just gone for the L1 person and we have appointed it. We have not even seen whether the person who has given the lowest quotation, does he address my requirement? Does he address the qualitative aspects of the item being brought? So have we identified my selection criteria properly? If yes, then we evaluate it on that manner. So it's very important. The message is it's very important to put in an effective control frameworks, the control activities in place. We need to identify the root cause, pinpointed root cause in a particular organization because of which that can happen. A delay in receipt of the material, there could be the delivery schedule not defined, delivery schedule not communicated, route map not clear. The person is just given, okay, come to this address, and there are so many factories in that location. The vendor is looking for the place. There's no clarity in the vendor contract, right? So take an example, and for this, I will give you a very classic example, and this is faced by each and every organization today. You order for X quantity, there could be either X minus or X plus coming in at our gate. Now, problem at times is our policy is not clear, or the item itself is of a nature that it cannot be received in the exact quantity that we have ordered. Then how do we address it? Probably the vendor is dumping their excess quantity to my gate, right? At times there is a challenge of the lot size, box size. How do we address it? It's very important that we understand the root cause properly. Now, if the reason is the lot size, then we need to be clear that the material master that we are creating, that is created as per that lots only, so that in future when we order, we do not face this problem. There could be a situation that the item which is coming in, even we are not very clear, right? We tell them, okay, whatever gets produced, you give it to us, but then how do we control organization who works on a continuous process? And then we need to have the process of like the open purchase order and then the release order and all. Why I'm taking the different reasons for the same risk is that we appreciate that the root cause and the reasons could be different for different organizations for the same risk. And hence it is very important. I'm again giving an emphasis on that. And this is an activity which are given least importance. At times even I have also seen practically giving. We look at the risk, we jump onto the controls. We look at the risk, we jump onto the controls. It's very important. We do the justice with the process. We identify the root cause properly. And then for each and every root cause, we identify the controls. There could be the one control for one root cause. There could be more than one control required to address the root cause. Okay. Now we have heard a lot about the risk, root cause, and the controls. Let's get a little bit more deeper into it. Let's understand what is the control. In simple terms, I think we'll not complicate this stuff. We'll keep it simple. Control is any action that prevents or detects what can go wrong. What can go wrong is a risk. So if I just remove what can go wrong, we can say risk. Whatever risk we have identified, any action that we can take either to prevent it or to detect it, we will call that activity as a control activity. So based on the nature, what we say, we can divide it into preventive or detective. As we saw in the definition also, preventive is something that will prevent that risk or what can go wrong to happen. For example, if I have to give a contract to a party, we do the proper technical and financial evaluation basis that we undergo a series of approvals. All those steps we say or the controls we say are built in so that we do not issue an incorrect order to a vendor. So the nature of this control will be preventive. It is preventing it to happen. There could be another layer of a control which is required is at times a detective control. And a very, very classic example, there are so many, but very classic example is the bank reconciliation. Now, why do we make the bank reconciliation? The event has already happened. Once the event has happened, we compare the bank book with the bank statement to identify and detect if there is any transaction which is wrongly recorded into the bank book or there is any transaction which has happened into the bank statement which is not recorded. And then we try to identify and get into the reasons. Okay, there could be the unauthorized payment that's happening, but it's not our attention. We have received some money, we have not done the accounting, whatever. But it will only help me detecting it once the event has happened. So all those events that help me detect once the event has happened, we classify them as the detective controls. Another classic example that comes to my mind is, and I think the last 2 years being more emphasized, is the audit trail. Now, why do we despite all the good internal controls and now through the regulation also we are trying to enforce the audit trail. Audit trail will be nothing, just the logging of each and every edit, addition, deletion. The objective is the post facto detection that if somebody, some manipulation, some unauthorized transaction was triggered, it is again a detective control. Not only the generation, somebody goes and reviews those logs. That will help detecting the unauthorized transaction. Not only that, somebody reviews and monitors and then take an action on it. That will make the control environment more strong. And not only that, once we do that, we revisit and try to build in a preventive control so that that transaction does not appear again. We call it as like the strengthening of the control environment, and that's how the complete loop is completed. And hence we say that for a particular root cause, there has to be the cluster of the controls at times that may be required to address that effectively. Now coming back to our definition, so based on the nature of the control, we may either classify them as a preventive or the detective. Next categorization comes is on the basis of the way we operate it. Either it's a manual activity or it's an automated activity. Another thing could be, it could be IT dependent control. The same example, if we have to reclassify it on the basis of the manual, automated and IT dependent, right? The manual is something somebody takes the bank book into an Excel, take the bank statement again into Excel, put up the VLOOKUP, try to matches the transactions. It's a manually we are trying to do it because of manual control. Today, with the advancement of technologies, all the ERP we have geared up, we have automated the process. And hence a daily bank reconciliation kind of a thing. You have got a transaction, bank statement is uploaded, system automatically matches both and throws out the unmatched open transaction for us to manually clear it. So to the extent if there is no manual intervention, we call it an automated control. And more examples could be that you do not allow to receive the material more than the order. You do not allow to make the payment more than what is received, and my system is able to control it. We have configured the system in a manner that it will not even allow it. All these are the good examples of the automated control. Now, third comes is the IT dependent controls. Now, somewhere for the purpose of operating the control, if I am dependent on a technology environment, we will classify them as a IT dependent control. At times we loosely call it as semi-automated also, but honestly speaking, there's nothing like a semi-automated. Either we call them as an automated or a manual or an IT dependent control. So, okay, IT dependent control, again, the classic example, the same thing, the audit logs that we say. We may presume it to be an automated control. The system is generating the audit logs automatically whenever we are doing any change into any transaction or any master. But only the recording will not strengthen the control. It will not help me mitigate the risk. Risk mitigation will happen when somebody reviews those logs and take action on the basis of the information that we get after that review. And hence we say that there is a series of control that is required. And that is the reason we call them IT dependent. The effectiveness of the control is dependent on a manual activity of a monitoring that we take. But to be able to do that manual activity, I am dependent on the system to generate certain information. And hence I am dependent on the IT environment for that. So all those controls will be classified that as a IT dependent controls. Okay, let's get a little bit deeper into it. I think through an example, though, I have tried to clarify that. So preventive control, again, on the basis of the nature, an error or misstatement, what does it do? It will prevent an error or a misstatement to happen. It will prevent a fraud or a misuse of an asset theft, an unethical behavior. So the bold word which has to be focused on, prevent. Any activity that will prevent what can go wrong, all that will be classified as the preventive controls. All those controls that detects, we may call them identify and correct, because eventually the control will be strengthened with the action. As we saw in the audit logs, only the generation of the audit log and the monitoring of the audit log is not sufficient. The action to identify those errors and correct it will be the completeness of the control. So what we say, anything that identifies and the corrects, those are the detective controls. Again, the same thing, any error, fraud, misstatement, anything, if it's on the basis of nature, we are identifying and correcting it post facto, so detective control. Okay. Again, operations based, we've discussed like manual, IT dependent, automated, well in through an example. Now let's look at how do we frame the control statement. I think very important, guys. At times it's very important then when we are framing a control, we look at the attributes, the assertions which we saw. We look at the attributes that it is through its nature addressing the what can go wrong, right? Which is very important. Just doing a task is an activity. It may not necessarily be a control, right? But if that task address some what can go wrong, that particular activity will be called as a control activity. So for example, here we say the company engages any XYZ actuary firm to prepare the actuarial analysis. So we are required to do some actuarial analysis and a provisioning basis that. Now, do we call this statement as a control statement? Because just hiring or engaging a firm or just getting a report or the actual report is an activity. Just by doing that, it may not, like we have saw in that example, if the audit logs are generated, we cannot call it as a control because that's just an activity which is happening. So management reviews and discuss the actuarial report, including the key assumption with the specialty to assess the appropriateness of the assumptions and conclusions reached. Now this review attribute is something that converts this activity into a control activity, because now you can take that action. If I go back to the same example, somebody reviewing the audit logs so that he can identify if there is any unauthorized incorrect transaction and then timely trigger an action to correct it. That complete activity will be called as a control activity. Another example, the billed revenue file is summarized at the month end and the total is recorded into revenue. Now, I'm taking this example. This is practically, we generally see when we look at the risk and control matrices, and most of the time we see that the team has included these kind of descriptions, and hence it is very difficult. It gets very difficult to test it later on. So the reason lies into the problem lies into the way the control is drafted, and hence I just thought it's important that we go into the drafting of the control also. So here again, the billed revenue file is summarized at the month end and recorded as revenue. It is again an activity. Somebody recording something, it's just an activity. But when we say that the manager verifies the billed revenue, tallies it with the invoice file, and then once verified, record it into a ledger, that verification is an attribute that converts this activity into a control activity. So that is very important, that when we're drafting the control, we're defining the control, we bring in that objectivity, understanding okay, whether this is only an activity or the attributes are there which will convert this activity into a control to address what can go wrong. Okay, now that's on the thematic side. Now we go into the stage 2, wherein if we have to define an internal control environment, internal control framework, how do we go into that step by step? So when we talk about the complete framework, now let me just for the simplicity elaborate on this. What do we mean by a framework? Because I've used this word so many times, it's important. When a particular risk level, we saw so many examples. Okay, if there is a more payment can happen, we have XYZ controls. If we have to catch the unauthorized transaction, we have the audit log, somebody reviews it, bank reconciliation examples. If we look at one risk, one control at a time, it is a control. When for an organization, we have to collectively address okay, organization have XYZ objective. To achieve that XYZ objective, there are so many challenges, and then there's a complete mechanism of categorizing into, and that is something that we will see. Once we categorizing them into different buckets, we say okay, there could be 100 risks, there could be 200 risks that could impact the organization or that could prevent the organization from achieving its objective. But to mitigate those 100 risks, we have XYZ controls, the complete repository. Again, through a mechanism, we weave into a matrix, functional classification and all that. But collectively, we may say there are 500 controls in place which will help mitigating this risk. So collectively, all this study put in together into a systematic format we call the framework. So it's nothing, just a collective set of controls put up in a structured manner. We address them as a framework, right, for the simplicity. Now, a particular internal control framework, or see from the objective perspective, it's an environment, because once all those activities are put in place, it will strengthen the complete control environment. Now, these are typically classified into 3 broad categories. One is something the governance. Now, governance is something the management at the top, the different stakeholders, what are the different actions being taken as a good governance that will strengthen the control environment. So the organization may have a good risk management system. There are independent directors into the board of directors. These are good governance initiatives, right? Because the independent person will not do something for personal benefit. It is expected that they will be doing it, they will be independent to the operation, and they will be able to ask the right questions. There are independent and qualified auditors appointed by the organization to identify what can go wrong, any manipulation, or give an assurance to the board and the audit committees on the financial statements, on the operations, on the transactions. The organization have a good succession planning. The organization have a good policies, procedures, systems defined. Now, all these are examples sorry, of a good governance. Management has set up a good management information system. Board reviews those MIS on a monthly or a quarterly basis. All those are examples of a good governance. Then comes the operations. Like the process level risk we saw, these are more or less resembling to that. The operations, whatever activities the people down the line they do it, they activities are called operations, and any controls that we put in place to strengthen those activities and to manage them better, all those are my operational level controls. The bank account receivable controls, segregation of duties, the audit log, access controls, whatever typically we can think about, whatever operation level activity we do, all those controls falls under the operational control. Then comes the financial reporting. The controls that we put in place to ensure that the financial report, because then there are so many stakeholders that rely on that, all those controls will be classified as the financial reporting controls. And there could be overlap. In general, all financial reporting control, there could be some governance and there could be some operational. That's for sure, right? But from the specific classification perspective, and there's a reason to it, because when we go to the regulatory mandate around it, this classification will be very, very much essential. Because for certain class of our companies, we have to look at all the things. But for certain class of organization, financial reporting controls assessment only is required. And hence this classification understanding is very important. All these three categories are broadly strengthened to different lines of defense. Though I have kept it as a lines of defense here, but this model has been changed. Now today we call it a 3-line model. But just for the clarity of this subject, it's very important because even the earlier model was very, very clear in itself. And I thought to put the 3 lines of defense model here. So there are 3 levels in which a particular monitoring or the controls can be, placed. The first one is the first line of it. These are the people who does the transaction. Somebody who is receiving the material, somebody who's making the payment, somebody who's recording the voucher. All those transactions, the people who do it, they call it as a first line of a defense. They report it to the senior management. Whatever monitoring, overarching, and the governance controls we talk about, those are the second line of a defense. Like we have the risk management in place, we have the quality procedure in place, we have the regular inspections in place, whatever we can think of. Both these things report to the top management, eventually to the board. Collectively is the management side of how do they build in the controls into the operations. And then we call it the third line, which are more independent of the operation, right? So the underlying line is the independent of the operation. It may be an employee. So internal auditor employed by the organization is still the third line of defense till the time he is independent of operations and have a direct reporting to the board and audit committee to protect his independence. So still be the third line, not necessarily the third line be the external person. So third line is who is independent of the operations, reviewing it, identifying the problems, reporting to the directly to the senior management and the board and audit committee. So that classification is very important because when we define the control, that is very important. Control is something that has to be owned by the management, that has to be implemented through the operations. So control is the strengthening of the first line and second line. Third line can contribute as an advisor, as a consultant, and as an evaluator to give their report whether this is right or not. At times, when organization, you have seen that this, okay, our financials are getting audited by the auditor, you please include this is also a control, because if it is not wrong, it is not right, auditor will highlight it. And you always counter back, the audit is always a third line of a defense. It cannot be the part of the control framework. Yes, as an overall governance, it's an important pillar. But when I'm defining a control, that has to be management controls to address the risk. Now, this is something that has now been changed from 3 line of defense to 3 line model. Why the defense word has been taken away is because today, as an internal audit, and more specifically, it's applicable for the internal audit, that as an internal auditor today, I just do not come and play a role of an inspector or just give my report. Through an years of experience, this is felt that internal audit contributes a role through their consultative role also. So we are now saying the 3 line model. While management is responsible for the first line and the second line, internal audit, while you be the independent, through the experience play the consultative role also, and then helps the management strengthen the first line and second line. A very classic example to differentiate it also, I will say, earlier, so take an example, the management is defining a policy, a purchase policy, and it comes to the internal auditor to seek their views. The typical response from the internal auditors was that I'm a third line of a defense. I will do the post-mortem analysis. Please define whatever policy you have to define. Whenever it comes as a part of my audit plan, I will come and review the policy and tell you where the problem is. Now, that is something has been seen very critically, because by the time you comes in and bring in the changes, it will be too delayed. A lot of damage and impact would have already happened, and it is only a timing difference. So why can't an internal auditor, if it is advised so, can give his opinion and views earlier also? And hence the entire structure. So one of the example been seen ki, okay, you can play a consultative role also. What is more important is that we do not compromise my independence. Till the time I have to play the role of an internal auditor, I may not define the company policy, but I can always play a consultative role, can review and tell them, okay, there are so many problems, please review it. When I go and audit it, does not mean that I have reviewed it earlier, so I cannot bring in the more improvement. In the lens of the new environment, the new business challenges, we can again look at it and suggest improvements into it. So it's been very, very importantly emphasized that we play a very good advisor and the consultative role and help the organization strengthen the entire control environment, even while it's being built also. And hence, let's look into, though I have touched upon it just in the previous slide, so what's been the auditor's role, right? That's very important, that while we are implementing the internal control or a risk management framework, what is my role? So it has been moving from saying the assess and make report around it. Yes, when it comes to the regulatory requirement, we will touch on that. There's no doubt about it that when it comes to internal financial controls report, we will issue the report. When we do the internal audit, we will issue the report. But the objective and the role perspective is it has to be more recommendatory, that how do we improve the complete governance and the control framework around it? How do we help promoting the ethics and value in the organization? How do we strengthen it to build in the management and accountability? The communicating the risk and controls. We could be the steward to it, take it to the people, okay, something is not going wrong. So something is going wrong. We address it then and there. Yes, we collect the appropriate evidence, report it, and take it to the top management also. But nothing stops us to have an open discussion to strengthen the control environment while that is being addressed. Okay. Now that's something on the complete governance, risk, lines of defense. What is the control framework? What are the different segments to it? Let's go a little bit deeper. Two things that we will now address into this section. The basics are clear. We will get deeper into what is the regulatory requirement into it, and then we will get little functional also. When we go into the internal control framework, how does it look like, what are the different components, what are the different functions we cover, and how do we ensure the efficacy and efficiency of the internal controls. So very interestingly, let's get more deeper into it. Okay. Allow me to speak. So this is a summary slide of what is it that the Companies Act 2013 has mandated. So there are certain compliance requirements with respect to the internal financial controls. So what does it say? Under section 134, the board of directors, that they lay down adequate and effective internal financial controls and included it into the director's responsibility statement. The first responsibility is on the board of directors. Please underline, we'll develop more theories from this. Important 2 words. It has to be adequate. It has to be effective. Now you will start joining the dots why I was addressing in the earlier slides the questions around completeness of risk, the questions around completeness of the controls, accuracy of the controls, because that is very important. We need a very scientific mechanism and an approach to address these queries, because as a board, when it's a compliance requirement, we have to be precise. We have to be clear what we are doing. It clearly mentions about adequacy and effectiveness. And when the law says my approach and a documentation should also be able to demonstrate that the control framework, which is defined and documented, is adequate as well as effective. We'll see how it happens. Independent directors to satisfy themselves on the strength of the financial controls. So what does it say? Casted responsibility on the independent directors also, but very clearly, independent directors' responsibility is not to lay down. Their responsibility is to satisfy themselves, or more like with the critics to it. Right? What is not right, have that corrected. If the framework is not there, please give a direction that this has to be built and this has to be documented, developed, reported, and all that. But primarily the responsibility is on the directors. Audit committee, they evaluate. So role of the audit committee is to evaluate. How they evaluate it? They take the help of the extended arm, which we call them the internal audit and the statutory auditors. But from the responsibility perspective, is the audit committee's responsibility to evaluate it, review the auditor's comment and the observation with respect to the controls before submitting to the board, and then discuss the issues with the management or the internal or the statutory auditor, because whatever we are talking about is a subject of the risk assurance advisory. So audit committee as a subcommittee of the board to address it, and then the matter can go to the board. So it does, the important is, does not stop at the audit committee. It's an interim stay, but eventually the board of directors are responsible. That's clearly mentioned into the Companies Act. And then what does the auditors have to do? They have to report on the adequacy of the IFC system and report on the operating effectiveness of such controls. So here I think you will see some difference, very small words, but it's very, very powerful and important to understand. On the board of directors, we have mentioned about the adequacy and effectiveness. So it's the responsibility. How do we address the attributes of adequacy and effectiveness? We will just see. But again, on the auditors, the same two words going hand in hand. Adequacy. But thankfully, for the auditors, they've added the word operating effectiveness. So as an auditor, I have to, when we give the audit report, to see that the controls are adequate and those controls are operating effectively. But there must be some reason that why this operating word is not mentioned in the board of directors. I don't know, something, but primarily, I think somewhere the responsibility of the board is much more. The objective is what is being achieved. It's okay, you define the adequate controls also, but whether those are effective or not, or whether these are operating effectively or not, whatever it may be, it's your responsibility. You have to ensure that it gets implemented on the ground. So with this, we go to the definition, and then we will try to have a more elaborated understanding around this. And there's a very limited explanation which is given into the Companies Act. There's just one paragraph which is mentioned, which is highlighted here in the blue. We'll read it here and then we will go deeper into it. So what this says, internal financial controls for the purpose of this clause, as it mentioned here, internal financial control means the policies and procedures adopted by the company. So it's very clearly it's talking about the policies and procedures. But for what? Adopted by the company for ensuring the orderly and the efficient conduct of its business. Doesn't it seem like that everything on the earth we have covered in the definition? How can either as a director also or as an auditor also, we can just cover each and everything. And if something happens, are we responsible? These are very important questions that should be understood, because somebody will say, okay, it's a company's act requirement, right? Why the risk was not identified earlier? Why the control was not put in place earlier? There could still be some surprises. So let's see how we have to address it. But apparently, reading from the definition, it appears to be a very, very wider responsibility. Then it says, including adherence to company policies. So it says you have the policies and procedures adopted by the company. So, and adequacy attribute is given in the direct section itself. So that has to be there. And it talks about the adherence to the company policy. So somewhere I think there's an overlap. They're trying to cover again and emphasizing on the implementation of the policies, the safeguarding of the assets, the prevention and detection of the fraud and error, the accuracy and completeness of the accounting records, and the timely preparation of the reliable financial reporting. So some way here, they have tried to give in the inclusive definition. One, the broader spectrum, and then through an inclusive definition, they have tried to navigate it. What do they mean by when they say policies and procedures adopted by the company for ensuring orderly and efficient conduct of the business? What do they broadly mean by saying this? Somewhere we are giving the direction from the inclusive definitions given in the part 2. So it gives the 5 assertions. They're talking about the policy procedure, they're talking about the safeguarding of assets, they're talking about the prevention and detection of fraud and error. Very interestingly, they have put in, we will see more on this, the accuracy and completeness of the accounting record and timely preparation of reliable financial information. So the same thing, now we see from this lens, all the assertions that we saw in the definition, we have put in as an IFC objective. So certain objectives, they talk about the efficiency and effectiveness of operation, we call it as an operational objective. Prevention and detection of fraud and error, we call it an operational objective. Safeguarding of assets, somewhere it's an operational objective. When we say the accuracy and completeness of record and reliability of financial reporting, we broadly call it a reporting objective, the financial report. Again, the compliance for the clarity, though it's not specifically mentioned into this definition, there are specific separate sections which talks about it, but the framework have to address the legal risk also, and hence from the completeness perspective, it is important that we study the compliance risk and the compliance requirement together with this, and hence this attribute is also been included here, the compliance with applicable laws and regulations, because it's been addressed at so many various sections. Now, interestingly to see, once we start understanding and be mindful, see, the MCA has given the Companies Act, there are not much detailed guidance and the elaborated mechanism which has followed this. So there are a lot of interpretations that have been drawn out of it. Thanks to our Institute of the Chartered Accountant, we came out with the guidance note, which helped us clarifying what is it that we need to do. And it's very, very clear, thanks to the Institute. And then there are global frameworks, the policies and the requirements that can always be leveraged upon when we are putting up a framework in place. And one of the framework is the COSO framework, which is globally most commonly adopted. And whatever we see, I think this broadly on the lines of the COSO framework. Now let's understand what do we mean by when we say the efficiency and the effectiveness of the operations. Do as a finance people, the government expect a chartered accountant, and for that matter, even the directors, a director could either be an engineer or a salesperson or a finance person. Nobody on the earth is like Sola Kala Sampoon, like Bhagwan Shri Krishna. So somewhere they also understand that one person may not know each and everything. What is more important is that it has clarified the policies and the procedures. So the policies will clarify. Idea here is that the organization should define the policies and procedures, how the system should work, and that policy procedures implemented on the ground effectively. So the regulators wanting to hit out, okay, the purpose is achieved. If the policies and procedures are effectively defined and implemented, the purpose of efficiency and effectiveness of operations will be achieved. The effective delegation of authority and the entity level controls are defined. We will see quickly what do we mean by that. Entity level controls are typically the governance level control attribute that we address, like whether we have the independent audit system in place, do we have succession planning in place, do we have the fraud risk management in place, have we identified and documented the legal compliance framework. All those initiatives taken at a board and a governance level are typically the entity level controls. From the prevention detection of fraud and error, important thing to understand it, they have used two different things together. They've used prevention and detection of fraud as well as error. Now, fraud is something in a gravity is a very significant we generally see. There is no differentiation between fraud and error. How do we differentiate it? The litmus test is in the intention. If the intention is to cause harm to someone and make personal benefit, we call it as a fraud. And if it is done unintentionally, it's an error. But why the lawmaker has used it together? Because probably at that level, there are no barometers to measure the intention of the people. So they want to clarify it that for this subject, we are going to see the fraud and error from the same lens. It's better whether it's a fraud and error, you identify it and you have the preventive and detective controls to manage it. So that is something that the lawmaker wants to address here. Then the safeguarding of assets, do we have the adequate controls? Now these are more specific, as we saw in the inclusive definition. Even the earlier two attributes are sufficient enough. When we are talking about the operation, definitely we are going to address the assets. Definitely we are going to address the accounting records. But somewhere these are more specifically called out. So we have this specific demonstration around the controls identified meeting these requirements. So when we talk about how do we protect the inventory, how do we protect the fixed assets, how do we protect the receivables, all those are safeguarding of assets. Accuracy and completeness of accounting records, somewhere specifically hinting about the controls on financial reporting, because unlisted companies and certain class of companies, they've been excluded from IFC, but the internal financial control of financial reporting under clause 8, it's been specifically mentioned. So on the financial reporting aspects, the internal control, whatever is defined, we call them as the internal financial control of financial reporting. So IFC by default includes financial reporting controls, but for those class of companies, only financial reporting controls will be important. So there, only the reporting objectives is something that needs to be addressed. That do we have sufficient controls in place to ensure accurate and timely accounting records, completeness of accounting records, and the overall financial reporting that is reliable. Again, the difference is, somebody may say, as a statutory auditor, we have always been giving our views. Our report is to meet this objective only, that whether the financial reports are reliable or not. Right? Now, that is more transactional nature, I will say. That, okay, we as an independent auditor giving our assurance to the stakeholders. But in IFC, this assertion means is, do the organization have a control in place to ensure the financial reporting will be reliable? For example, when we say the control in place that my finance head reviews the trial balance before making the financial statement, all the provision entries are reviewed by the finance head. The CFO reviews the quarter on results. We look at the inventory aging, we look at the vendor aging, whatever specific level controls we make. Those are the control mechanism. If all those things are working effectively, we will say that eventually the financial report that gets prepared after undergoing through such strong control environment, the reliability of the financial reporting will increase. Statutory audit report gives an additional stamping on it. Okay, we have the strong internal controls also. Now the statutory auditor has also signed this, so my reliability of the overall financial reporting increases. Now, under this section, when we have to give our report on the IFC, we don't just evaluate the reliability of the financial reports, we also evaluate the adequacy and effectiveness of the underlying internal controls which were defined and implemented by the management and used and very relevant for the preparation of financial statements. And then again, the compliance with applicable laws and regulations, again addressed at two levels. One is whatever the financial reports or the transaction, whatever the underlying laws and regulations, we look at all the controls from that perspective that the organizations adhere to it. And another at a governance level is, do the organization have the complete legal compliance framework? Because not everybody would know each and every compliance requirement. So it's very important that you have the complete compliance requirements identified, document, responsibility of implementation, responsibility of monitoring of implementation being identified, and which we in summary form call it as the compliance framework that's been there and implemented. Okay. So while looking at these objectives, which comes out from the definition, we touched upon internal financial controls, internal financial control of financial reporting. But for more clarity, I think let's look at this example. This is the example that we have seen. See, in a typical purchase cycle, there are certain steps that you have to follow. So the purchase cycle will start from the purchase planning. Then you have the vendor master maintenance. Whatever vendors we have the masters. Now, whatever we talk, we are talking about the reasonable in ERP environment, which most of the organizations these days are working. So we have the vendor master. Whenever any item is required, user raises the purchase requisition, basis which the purchase team issues the tender. We do this and vendor selection and the negotiation. For the selected party, we give the order. Against the order, vendor provide the material. Once the material is received, we record the invoice, we make the payment, and after that in the year end, we evaluate whether the vendor performance was good or not, how is it like, so that we do a continuous improvement in place. Okay. Now you will see there are certain activities which are mentioned in gray and certain in blue. Now the blue are the one which are financial reporting control. The litmus test which I generally prescribe is that we have to see that by making that activity, by doing that activity, does it have any impact on the financial records or not? For example, when a request comes from the user to purchase a material, there is no financial records getting hit. There's no trial balance impact. There's no provisioning. There's no note to accounts. So my financial reports does not get impacted. In the purchase planning, my financial reports does not get impacted. Till the time I call out the RFPs, I evaluate the vendors, does not impact it. But once I receive the material, my invoice liability has to be there. My liability to pay arises. Once I receive the invoice, I record it into the vendor's name. So all these activities will impact my financial statement, and hence the controls around the activities which has impact on the financial statement, those are internal financial controls over financial reporting. The other activities which has the impact on the efficiency of operations, like for tendering and requisitioning, if I do not have tendering process, I may end up making the inefficient procurement, and those controls hence are covered into the internal financial controls. Two questions which are generally raised here, I will try to address. One is, for example, the vendor master and ordering. When we raise an order, practically speaking, we do not create any accounting record. It's a contract or an order, we issue it. But why still it is covered into internal financial control of financial reporting? Because this is an activity and the vendor master is an activity. In today's environment, if something goes wrong here, my payment transaction directly gets impacted. If, for example, in my vendor master, my bank account number is incorrect, I may have my liability booked to X person and payment going to Y person. If my ordering controls are not right, even if my selection process, I have agreed to buy something at 100 rupees, and if I just create the purchase order of 120 rupees, it will be my financial reporting impact, and hence those are covered into internal financial control over financial reporting. Number two, what do we mean by efficiency and operational aspects? The attribute that we saw in the IFC definition, and hence why we are covering the tendering, etc. into the IFC, because there's an efficiency. If there's an item which has a market rate of 100 rupees, if through the organizational inefficiency, we procure it for 120 rupees, a very simple example we're taking, an item generally worth 100 rupees purchased for 120 rupees, whether it is recorded rightly at 120 rupees or not, these controls would relate to internal financial control or financial reporting, and how effectively the organization has purchased that material through my selection process, through my negotiation process. So the items, I do not end up paying more, I end up paying the reasonable amount. All those controls are my efficiency controls and a part of my internal financial controls, right? And hence my internal financial controls are somewhere more operational in nature. Okay. Again, I mentioned about from the framework perspective. So we have understood the difference between IFC, ICFR. From the COSO framework, because the framework globally which is adopted is the COSO framework, they give these kind of a classification for all the controls. We have touched upon the entity level controls. We have touched upon the process level control. And then when we are talking about the financial reporting controls, there would be certain controls which will come into a period ad control, because this will not be performed regularly on an ongoing basis. Typically the cutoff procedure, like at the year end, we do the inventory count, and then we see whether that tallies with my books or not, whether there are any unaccounted inventories, or all those cutoff procedures that we take with period ad controls. IT controls, because whatever we do into the system, it is controlled through certain IT controls in terms of the access that we manage, in terms of the logical security, data management, incident management, all those things. Why it is important is because today we are talking about the digital records. If these controls are not very much in place, we don't know whether my financial records are safe, data integrity is there, or there could be some manipulations, right? Which apparently on the face of it, I may have segregation of duty in place. Somebody is looking at the document, but if there is a possibility somebody can change the transaction from the back end, the entire purpose of the control environment is defeated. So that's one of the examples. So, and hence the IT general controls are also made part of the framework, very important. Anti-fraud control specifically been called out in the Companies Act, and hence when we identify the risk, we specifically try to identify what are the fraud risks and what are the specific controls to address those fraud risks. We call them the anti-fraud controls. Again, it could be both at the entity level or a process level. So like the whistleblower mechanism, code of conduct, and all those are the entity level controls. At a process level, when we have the maker checker, segregation of duty, somebody looking at the documents, independent confirmations, there are so many anti-fraud controls that we built in that somebody is not able to do the unintended manipulations. Some deeper deep dive into the ELC, but this is more important. The ELCs that we spoke about, the entity level controls are typically like whether the organization have good risk management system in place, whether the organization have business ethics framework, the whistleblower, code of conduct, internal audit and financial integrity. Again, very important. Having an independent internal audit function is a good entity level control. But what internal auditor goes and checks at a transaction level, it operates at an operating level, which is more of a process level, right? So just having an independent structure, they are independently to define their scope, they are independent in their reporting, the structure which is in place, so that the report of the internal auditor is more relied upon. That is what we are talking about as an entity level control. And what other financial integrity controls in play, the delegation of authorities, segregation of duties and all. Legal compliance framework, we touched upon the fraud risk management system. Business and operations continuity is very, very important in today's environment. How does the organizations ensure it? Succession planning, is it like something, it is highly dependent on one or two people? Today something happens, whether the organization will continue or the big damage that can happen to the organization, and the management operational review at various levels, right? These are typically the entity level controls. And then at the process level, when we look at the purchase finance process, here I am going to introduce now the risk and control metrics to you. What we do, the steps that we have seen till now, once we identify all those risks and document all that risk in the structured Excel metrics, like we have the business activities, what are the underlying risks, and then what are the controls in place we have to mitigate those risks. Control 1, 2, 3. Once we put all that collectively into a matrix, we call it a risk and control matrix. Now, this is nothing, it is just a mechanism to document the control framework. But again, as we saw earlier, the collection of all the controls together, defined and documented in a structured manner, we call it as a control framework. But the process level controls documented in this kind of a matrix. Again, when it comes to the effectiveness part, so if all the controls have been identified correctly, documented, and there's a comfort around the completeness of the controls, that's the giving the comfort on the adequacy attribute. In the definition we saw, these are two parts, adequacy and effectiveness. But when we go and see the people on the ground are following those controls, and there are different mechanisms we implement to check whether the people are following that or not. That is something that we call as the operating effectiveness. The merely people following all those controls, implementing on the ground, at that state itself, we can call it as that it is performing effectively. Testing of the control is just a mechanism to test whether the people are following or not. It's like an audit report. Because somewhere if we have to demonstrate, how do we rely on the people saying, okay, we are following it? There could be surprises later coming, So as a best practice, there is a mechanism of going and doing the testing. As an auditor also, we go and do the testing before we issue our report. And hence, that gives a comfort to us and then to the management also. Okay, we have taken the samples. And then a lot of methodology defined around it. We have taken the samples. And all those samples are effectively working as intended, as the controls are defined, and hence the controls are operating effective as well. Again, little bit getting deeper into, we have seen the entity level, we have seen the process level, the IT general controls. The IT general controls are typically, one is the application level and other are at the logical level. Now the application levels are, so like today we have the SAPs, Oracles, or the ERP systems. The process level controls which we implement within the application, we will call them as an application level controls. For example, the purchase order is approved within the SAP system by the defined peoples. It does not allow to receive the material more than the order, does not allow to make the payment more than the material received. All those things we call them an application level control. These are operating within the application. And there are certain controls which are around the application. So like how my data center is operated, what are my typical security controls, the network, the physical security, the access controls. Because if these controls are not operating effectively, the possibility of manipulation cannot be ruled out. So there are the application level controls, and then there are the general controls like network intrusion, integrity of the data. Do we take the data backup and we do the restoration testings or not? Whether there could be the leakage of confidential information. Today, the organizations are implementing the DLPs. There are highly sophisticated software applications called the data leakage prevention plans. They run in the background, and somebody tries to, based on the predefined logics and the keywords, somebody tries to take the data out of the organization. It will flag out or it will control it. Now, those are the kind of things which are also as a part of the general controls, IT general controls, we need to address. And then once we define the framework identify all the risk and controls. How do we take it to the management as a snapshot? It's like a typical dashboard, but it could be presented in any other beautiful MIS. Like you have the business cycles, you've identified what does my risk universe looks like. So this is like an illustrative for an organization. You have 240 risks amongst different functions. Out of 240, you have 85 fraud risk. Because my definition of IFC has been talking about the fraud risk. It's very important. My framework also specifically mentions about it, and we demonstrate that, okay, we have identified fraud risk. And then the upper half shows the control framework to address the fraud risk. So like 118 preventive control to mitigate 85 fraud risk, and 24 are detective. 119 are manual, 23 are automated. More the automated are better, more the preventive are better. There is no defined threshold, but the more the better. Again, to address all the risks from the control universe perspective, we have 262 preventive controls, 48 detective, and again the bifurcation between manual, automated, key and non-key. There is something, a concept of key and non-key also. I don't know if I have kept a slide, but I will just explain it here. See, as I mentioned, the effectiveness part get addressed the moment the people on the ground follow the control environment, follow the control definition which is there. Testing is just a audit of those activities and generate report out of it. And hence, at times, to make the testing effectively, there is a classification, something called key and non-key. We give more emphasis to the key control, and maybe at a lesser frequency, we can test the non-key. It does not mean that non-key are not important, but the definition of the key says that these are those critical controls. If these are not working effectively, the probability of the risk impacting the organization is much higher. Or in other words, there is a very less likelihood that my risk be prevented or timely detected if my key control is not in place. And hence, these key controls are given more emphasis, and generally, like with more of a prioritization, you can test it more oftenly and more significantly. Okay, this slide again, I was addressing about the risk, I was addressing about the controls. I think again, I should just quickly touch upon, because we're talking about the fraternity of auditors, very important. How do we look at the completeness of the framework? See, how do we start this exercise of even identifying, how do we define the control framework, which are the business activities which should be the part of it, at least for the internal financial control over financial reporting, and where specifically the statutory auditor also needs to give the report is, the scope is limited to the financial reporting controls. Now, how what we do, I think one of the good methodologies that we take out the trial balance or all the financial records and then try mapping what are the different business activities through which this particular financial transaction gets impacted. So, for example, when I say my accounts receivable have a balance of 1 crore rupees, so I will map against account receivable that my order to cash cycle and billing activity. In this activity, this particular ledger gets impacted. So once I find out what are the possible risks around billing and what are the controls around mitigating those risks in the billing, we can say that we are comfortable that for all the accounting records, for all the ledgers, we have identified the underlying business activities. For all those business activities, we identified all those risks. And for all those risks, through the root cause, we identified all the internal controls. So the completeness of the frameworks is ensured. This is something that we have discussed, just this step-by-step methodology. Again, another important aspect, I think the remediation I will just touch upon here is, what happens, you have defined the control, but once we take an example, we were testing it. Somewhere it is followed, somewhere not followed, certain transaction it is followed, somewhere it is not followed, or we may realize that my controls requires an improvement. we call it as a remediation, right? So we tested, it failed. We again issued the direction, okay, this needs to be followed. The control either in the modified form or in the same form, again implemented. After implementation, we again check through certain samples and again go for a testing, okay, whether now the remediation has happened or not. Two things very important: the materiality assessment, because if the control was not working earlier, whether it has impacted any financial reporting or not. Because if that has impacted, so then we have to rectify the financial report also. And if it is just a matter of the control implementation, then we go for the remediation and say, okay, the control made effective, it was operating effectively before the year end. How do we go about the design effectiveness testing? Again, we have identified the root causes, we have identified the risks, but important is the different techniques that we mentioned is, one is the inquiry, we discuss the process, we look at what are different scenarios because of which all those material misstatement may happen, and again asking the questions around all those assertions. Now we are narrowing down towards the financial reporting control. There it works very effectively that once we inquire, once we look at the documents, once we do the flowchart study, we try to address what is the control in place to ensure the completeness, what is the control in place to ensure the existence, what is the control in place to ensure the accuracy, the control in place to ensure the authenticity and the presentations. All those assertions, once those are addressed, I think we can look at the all angle of the control environment as we just discussed on this slide. Again, from the operating effectiveness process, I think in principle we have seen, but if by the process we have to go, I think very first important step is determine the testing objective. I think that is the reason I introduced the definition and the difference between the key and the non-key controls. What is it that we want to achieve? What is the objective of the current exercise? Do we want to test all the key controls? Do we want to test all the controls? Is it an interim testing? Is it a final testing? Is it a remediation testing? That objective clarity is very important. And then at a level 2 is understanding the objective of the control being tested, right? So if I'm testing a payment control, the objective of that control is to ensure timely and accurate payment. So whatever control we are testing, that has to address that need. Define failure condition, or generally we call it them as a test attributes. Depending on the definition, what are the different conditions we have to test? For example, again in the payment control, we want to check whether the invoice was approved as per delegation of authority or not. This is one of the conditions, right? Whether the invoice tallied with the GRN or not, another condition. Whether the invoice tallied with the purchase order or not, third condition. Whether there was a maker checker control implemented or not, like executive 1 putting up the transaction, somebody posting it. So all the different conditions that we have to test, or we call them the test attribute also. Define the conditions, define the population. What is the total population and the frequency of the control? Is it a quarterly, ongoing, regularly, monthly control? Because depending on that frequency and a population, we have to identify my sampling methodology also and a sample size. In the guidance note also, depending on this frequency, we have a prescribed sample size, but believe me, higher the better. And today with data analytics, I think so many things can be tested using the data analytics and the robotic tools. Though not the part of today's session, but we had done some study and realized as high as 60 to 70% of my entire control testing can be automated. You can think of, and that too on the 100% of the population. If an organization is reasonably, I'm not saying best in class, reasonably good technology implementation is there, that is the percentage level that can be achieved. So if that kind of a technology support we have, why do we go to the sample? But yes, from the compliance perspective, if that sample threshold is achieved, we are home. Then we do the documentation. The documentation is in the form of a test script, that where we identify that this is the objective we have to test, what is the sample, we define what all things that we are talking about, and then a description about all the samples that has been taken, and in all those samples, whichever attribute is pass and fail, eventually my test is finally pass or fail, and ensuring that we have the sufficient evidence and the backup papers in place for both, because the testing of the control somewhere is a positive assurance also. So when we say something is passed, so why? When we say something is failed, so why? So we should have the proper evidence for it. We evaluate the exceptions. We finalize and sign off the final documentation. Wherever there are failures, we do the remediation. These are recommendations. Some changes required. People do it. As we mentioned about the remediation testing, we retest it and then the final report. This is just a glimpse of the sampling criteria, like it's the recurring. So again, there's a high risk of failure, low risk of failures. This is again can be defined through the entity level controls also. See, in the COSO, those not, I don't remember if it's specifically mentioned in the guidance note. See, COSO has also beautifully and specifically the SOX methodology, which is like the global version of what IFC we have been talking about, that clearly says that if my company level controls, which we refer here as an entity level controls, are adequate and operating effectively, the reliance, it says in a positive term, the reliance on the operating controls increases and the organization can go with the little lesser sample testing. And in the SOX implementation, the SOX audit, there is a method of technically computing the reliance percentage, how much reliance can be placed. If that reliance is good, the sample size of testing could be reduced. Because the presumption here is if my governance is strong, then the people will follow it and the chances of the failure at an operating level gets reduced. So that's how the different sampling guidelines we follow, and through the testing we implement it. So that's there on the regulatory requirement, and specifically how do we go about. I think there were many things to cover today, from the risk landscape perspective, the complete risk categorization, different categories of the risk. Then we come to the control, the governance, operating, financial reporting. What are the regulatory requirements? What's there as an IFC or the ICFR? Certain class of companies is the IFC there. Unlisted companies, you do not have the IFC, the ICFR. And then how do we go about the testing? So that's it from the today's session. I'm sure there would be many questions today. So we would want to invite Sharvari ma'am to take up the questions, and we would be so happy to address any queries that you may have.
Yes. That was indeed a very insightful session, sir. It was great. I mean, we never thought about internal controls framework in such a manner and in such a deep methodology, maybe, because this is another point of certification in our audit report, and probably it is generally not given all that importance that it should actually have. And I guess this internal control framework is something that, is a very key part of an organization's success. Without internal control, probably an organization can land into problems, or it can succeed, and also cost effectiveness, value addition also comes out from this as well. So I will just check if there are any questions from the participants, so we can otherwise we can conclude this session for the day.
Sure, surely.
Let's give a minute to the participants to post any questions if they have. I guess there is a question saying that can we get the soft copy of this presentation? I think that should be available and we can share that across the participants. Actually, the presentations has said it all, so probably I don't think there are any queries from the participants regarding this. I guess we can share this presentation with the participants, and I again thank you, sir, for imparting all this knowledge of yours with all of us regarding the internal control framework. And I also thank ISB ICAI for conducting such a session wherein it also opens up a plethora of new opportunities for budding CAs, which can, we can divert it from stat audit to GST audit and get into actually the management of a company and prove some value addition to the companies as well. So I guess we can conclude today's session here, and I thank all of you to be here and participating into this webinar. We'll meet for the next webinar very shortly, and thank you all for being here. And Mohit sir, thank you so much.
Thank you so much to you, Sharvari ji. Thank you so much to all the participants. Pleasure is all mine again to be here, talking to the fellow colleagues and the professional. It's a mutual learning process, and I always enjoy it. Thank you so much again for this opportunity. Look forward to the many more sessions. Thank you so much.
Definitely, sir. Thank you so much.
Have a great day.
Right.